All right, all right, all right. Another Monday night, another live Q&A. Matt the Mortgage Guy, happy to answer any questions you have in regards to mortgage, real estate, the market, anything that really you have questions on. I have a very, very fun time every time we dig into questions. I don't know what to expect. I don't know what's going to come. And every week it seems like there's more stuff where I'm like, oh, I didn't expect that. Haven't heard that in a while. So it's a learning experience for both of us. So I'm looking forward to having some more folks jump on. We can get into it. We can talk about anything you're seeing in your market, any questions you have, whether you're in process on a mortgage, whether you're thinking about getting one, whether you're refinancing, whether you're purchasing something. There's always questions to be had. And sometimes, even if you're working with somebody that you like and trust, it's nice to get a second opinion. I take pride in helping folks through the mortgage transaction, whether or not we're working with them, right? I've gotten a bunch of feedback. Thank you so much. You really helped us out during the buying process. Folks that we didn't personally work with, and I was able to help them out. That feels good. So looking forward to jumping into it next week. I've been doing a bunch of live Q&As where it's just me. Next week, I'm going to have back on special request Ryan Lundquist. He's an appraiser in my local market. He's well known because he does really cool stuff with real estate stats, really follows the market closely, gives his feedback on it. He's a really high level appraiser, has been for many years, but also, statistician and one who follows the market and provides a bunch of good information to local real estate agents, local mortgage folks, whoever's really interested in that information. He's great. So I'm going to start putting together questions I have for him next week to get his take on some of the things that's happening, not only with the real estate market, but with appraisals and whatnot as well. So that should be a good one. Before I jump into it, I like to get, a couple dozen folks on here so that we can start getting questions. Something that's been on my mind is all these different things that I see online when it comes to conspiracy theory type stuff, right? And you guys will see my video tomorrow. I recorded it about it's a TikTok video that's gone viral of, Zillow's conspiracy, right? They'll buy 30 houses at 300,000 and they'll buy the 31st house at 340. That 340 sale will bring up the comparables so that they're going to make an extra 40,000 on every sale. Now all of a sudden they've essentially made an extra 1.2 million because everything's worth 40,000 more. I'm going to confirm with Ryan next week. I already know the answer, right? Like one comp isn't going to pull the whole market up. And so the idea that they could do something like that and they could, control the market, manipulate the market, a little bit far-fetched, little conspiracy theory-esque, but nonetheless, really entertaining video by that real estate agent who's in Las Vegas. And so, interesting stuff. You'll see my video on it. Let's jump into some questions. Thanks so much for those who are joining us. We got Rosie Perez. Really good question. A question that's come up more often these last 2 years than ever before. How often can I refinance? Lenders in general don't like you to refinance more than every 6 months. And here's something to think about. As rates were coming down these last 2 years, I've done 3 refinances inside of 24 months for certain clients where it actually made sense. Where it wouldn't make sense and where you couldn't continue to do this every 6 months forever is that there's costs involved with the refinance. And while you might be able to do a refinance where, you pay a little bit of fees, but you save $250 a month, so this thing pays for itself within 6 or 8 months, you couldn't keep doing that because one, you're not going to have that continued benefit, going from 3.875 down to 2.875 on a $300,000 loan, you're going to see $3,000 a year in interest savings. If you paid $2,200 in costs, okay, the thing breaks even in 7 or 8 months or whatever that math turns out to be. But if you now have a 2.875, like you refinance again, you're not gonna be able to lower the rate and have a big savings where it's going to offset the cost, right? So you wouldn't necessarily want to do it very often. And, these refinance break-even analyses are something that most good loan officers are going to walk through with you. And they're going to say, okay, what's the benefit? What's the cost? What's the break even? Sometimes it's like not that straightforward with math, because I'm going to take out 30,000. I'm going to pay off some credit card debt. And so you can't just necessarily do like a break even analysis on saving this much per month versus this cost. It might be, well, I'm paying off credit card debt and I'm going to be able to, get rid of $30,000 in debt that's 20% interest. So, really long-winded answer, but I wanted to give a little bit of, I guess, context to it, that it depends. Every 6 months is, technically you could, you're not going to want to. But in these last 2 years, some people have gone from this number to this number and they've pulled out cash, and then 9 months later they can, drop it another 0.5%. I don't think we're going to continue to see, rates decrease and a 1.625 on a 30-year fixed anytime soon, but who knows? We left it behind. Thanks for joining. What is going on with jumbo loans right now? A lot of stuff's going on with jumbo loans. They're coming back for a lot of lenders, more jumbo products. And, they're doing them with less overlays, meaning less extra rules. They're doing them with smaller down payments. Tons of lenders are getting out there and doing 10% down jumbo. And so, if you want to get more specific on what's going on, we can answer any of those questions for that, specific question, what's going on. That's what I think. I think of more products, less overlays, more options, right? Is what I'm seeing right now. Jeanette, hello from Cali. Thanks for joining us. I see you just popped a question down below, so I'll skip down to that one. I want to refi in a few months, most likely FHA. If I have a lot of equity, will I still have to do mortgage insurance? Nope. Well, yes. Why would you want to do FHA? If it's because of credit score, where FHA might be your only option, then unfortunately with FHA loans, no matter how much equity you have, you've always got to pay mortgage insurance. So if you're able to do conventional, I highly recommend it. But if you've got a 607 credit score and you can't go conventional, then good news is you can still get a loan. Bad news is it's got to be FHA, and FHA always has mortgage insurance. There's no FHA loans that don't have mortgage insurance. Jorge, good to see you, man. You're very welcome. Closing this week. Good stuff. It's a good question, Corey. Thanks for joining. Are high-performing loan officers able to overrule an underwriter during unique circumstances? This is a great question. And so underwriters are interpreting mortgage guidelines, and they're underwriting the file accordingly. And they're saying, based on Fannie's rule, based on Freddie's rule, here's what we need from you. Here's the type of documents we need to satisfy this condition. Fannie Mae, Freddie Mac, wherever the loan is going. And you can't necessarily override an underwriter, but here's what happens in the real world. Average underwriter, and especially if they're underwriter one, or they're new, or they're less than a couple of years experience, they are you guys let me know if my volume's okay. I'm in the new office. I got kind of a new setup and I'm not settled yet. So hopefully the microphone is within a reasonable distance. We're good on volume and whatnot. I know I've got a new camera that should be sharper. It should be crystal clear in HD. But a high performing loan officer who sees thousands of loans and really high level production manager, processor, people who are working on that team are going to be able to tell an underwriter, hey, listen, here's what you thought and here's what you asked for. Here's the rule. Here's a past case. And it's almost like when you're in court and you say, look at that past court case, how that was ruled. See that? That's why my client is innocent. And that's where we can say, hey, look at these past loans that underwriters who are more seasoned than you and who have more experience, how they've quote unquote ruled. We don't need that. This will suffice. Clear that condition. And with the best lenders in the country, you can escalate and say, I don't think underwriter is correct. Here's why. Escalate. Underwriter 2 will get involved. Senior management will get involved. And good loan officers with high performing teams will continue to escalate until they get it cleared, right? And so that might be where you're seeing, or maybe a loan officer is telling you, listen, I can get this thing cleared because I'm high performing around here. You don't get to play by different rules, but if you know enough about the game, you might be able to shape the rules, something like that. How many different kind of mortgages are there and what are they? There's a lot. The most common, obviously, are conventional, FHA, VA, and USDA. And then there's a bunch of mortgages that wouldn't fall under those, conventional conforming types that are, private loans, portfolio loans. And those can be debt service coverage ratio loans, bank statement loans. You can get private lenders and hard money lenders that can basically make up whatever rules they want, right? And so there's a ton within those different mortgage types. There's 10-year, 15-year, 20-year, 30-year. There's adjustable rate. There's fixed rate. There's lots of different combinations. Kenneth, thanks for joining, my man. Do I work as a commercial mortgage broker? No, I'm only residential. So that's 1 to 4 unit residential mortgage stuff. Nothing in commercial. So office space commercial, not me. 5 units plus on an apartment, not me. Anything commercial, not me. And I've never heard of luxury mortgage broker, but consider me luxury. I do loans for $176,000 and I do loans for $2.42 million. And so, as long as it falls in that space, 1 to 4 unit, we can do it as a mortgage broker. I've got dozens of lenders with hundreds of products. And so luxury mortgage broker, never heard of that, man, but that's a nice term, man. I've done my fair share of jumbos this year. So just consider me luxury. All right. Good evening, Mr. Kevin Hawthorne from Florida. Hope you're doing well, my man. Oh, okay, I see, Jeanette. You got a Chapter 13 BK, and so because of those seasoning requirements for conventional loan, you can only do FHA. Here is my advice to you: if it's I need to refinance because I need to pull cash out, or whatever reason, if it's a must do a refinance now, rather than taking 2.5% or 2.375% on FHA, take something like a 3%, get a whole bunch of credit so that the loan costs you next to nothing, knowing that when you're out of that seasoning period required for a conventional loan, you can refinance into conventional, drop the mortgage insurance, and you won't have stuck a bunch of money on that mortgage balance when you did the FHA loan, right? You don't want to do that and have your balance go up by $17,000 only to refinance into conventional later. Pay the higher rate, get a bunch of lender credit to cover all the costs, which you can do when you do 3% instead of 2.375. And if you need any help with that, let us know. Shoot me an email, matt@mattthemortgageguy.com. We'll walk you through it. Kenneth Wiley. It's a great question, man, because this has changed. I was an only California guy for the last 7 years, and due to everybody saying, man, I wish you could help me in Tennessee. Man, I wish you could help me in Florida. Man, I wish you could help me in New Mexico. I wish you could do Nevada. Here we come. Nationwide. Just made the change really in transition now. But I've already got stuff going in Florida and Tennessee and other states. So greatmortgagebroker.com. Where is that? Let me see. Great. I'll put the link in here. This is the easiest way, is just to fill out the 6 quick questions. My team will be able to take that and say, okay, I'm going to hook you up with Brandon. He's in Colorado. I'm going to hook you up with Brandon, who's licensed in Florida. I'm going to hook you up with this team member who's licensed here. I got somebody on my team who's already got licensing set up and able to help you out. So greatmortgagebroker.com. I'm not sure if that shows up in the comments, but let me see. Let me see if I can figure it out how to do that. I think it does. Yeah, I think it shows up in the comments. I did it twice maybe. Technology is not really my thing. Mortgage really is. So yeah, greatmortgage.com, greatmortgagebroker.com. Whatever state you're in, we can help you out. Turk East Bay. My guess is you're in the East Bay. I mean, I know, genius level deduction there. Are home prices increasing? Is home price increase in California accelerating again? I don't want to say no, because I've seen some wild stuff. Seen some wild stuff in these last, 30 days. And without looking at stats, I can just tell you, 90 something people pre-approved and out there shopping, and, hundreds of folks we're talking to in different stages of getting pre-approved. And I have people offering 40, 50,000 above ask in entry-level neighborhoods where it's $400,000, $450,000, $500,000 purchase price, not getting accepted. And so I heard somebody's stat about in the last 30 days, inventory starting to shrink again. And demand might be down a little bit, but also supply in a bunch of markets, specifically down in Orange County. Jeb Smith talked about shrinking supply because he's tracking his market really close. And so the answer might be yes, Turk, that accelerating again, there's like a resurgence. It's frustrating. It's tough. And I'm wishing for the opposite for all my clients who are out there trying to purchase a house, but kind of is what it is, right? All right. The one KCH, thanks for joining. How long will it take to close after being in contract, and when is the earliest you can lock your rate? Earliest you can lock your rate is when the loan gets submitted by the lender. It can only get submitted once you have an executed purchase contract. And so a lot of people are like, hey, while I'm shopping, can I lock in my rate? Can't really do it like that. You have to be in contract. And so get the contract, get the fees from title, disclose your loan, lock the rate. That's when you'll lock it. And you should be able to close, if you have a fairly straightforward deal, 17 to 25 days. I've got most of the agents I'm working with writing contracts that are about 25-day close, because it's taken a few weeks to get appraisals back. As much as I'd love to think that we've got more control over appraisers and appraisal management companies, we don't. And, that's one of the lags in the market right now. Good news is, starting Friday, October 1st, a lot of loans that I'm sending to the number one wholesale lender in the country, United Wholesale Mortgage, we can order through a thing called Appraisal Direct. And that's going to speed up appraisal turn times, is the hope. So we shall see. All right, Kevin, thanks for joining. Any tips on refinancing with cash out while coming out of forbearance? Well, the first step is you got to come out of forbearance, and different lenders still have different stances on this. Some say, we want you to come out of forbearance, make 3 payments, then we'll refinance you. Other lenders are saying, once you're out of forbearance, you're good to go. We can do a cash out refinance. Just keep in mind, you're going to come out of forbearance. They're going to ask you, do you want to look at a modification? Do you want to have us slap that balance on the back end of it? I don't know what the name of it is. Offhand, I forgot. There's a funny story after I answered this, as I was on a 3-way call with a client today, listening into their conversation with the servicer on their loan. But you're going to come out of forbearance. And so from a lender's perspective, we're not going to see that you have any past due. We're just going to show that, you've got your next payment due on November 1st. Your first mortgage balance is $317,000. And then we're going to see, okay, you've got $23,000 due from the forbearance amount. We'll refinance you. You'll pay off that first, pay off that forbearance amount, and then pull out cash. As long as you've got the equity and the credit and you qualify for the loan, it's just like any other cash out refinance. And the real quick side note was, I was talking to a client today who called me, happened to be on hold when I called them back with their servicer. And so, I got to listen in. Hold on, let me answer this real quick. And the servicer was basically saying, we're going to send you, if you request it, terms on a modification. Once we send those terms, you can look at them, you can accept it, you can decline it. And I think that that's probably going to be a good route. I haven't seen enough of them to know that they're all going to be good offers, but I've seen a few where I'm like, okay, like a modification might be what works best for some people. And I say that knowing that's not business for me as a mortgage broker. Somebody who wants cash out, well, we're going to serve those folks and help those folks, because you can't do cash out with a modification or working with a servicer, but you can do cash out with a mortgage broker. Anyhow, I think for people who are just looking to lower their payment and lower their rate, first talk to the servicer. Ask the servicer, what kind of modifications terms can I get? Send them to me. They can send them to you and you can say, no, never mind. I'm just going to exit forbearance, look at a refinance. But doesn't hurt to take a look, right? See what that is going to look like. Sarah Ann, thanks for joining. First time home buyer. How early should I get pre-approved? Should I get pre-approvals from multiple places so I can compare rates easier when I get my mortgage? This is a great question, Sarah. Very common question. And I think if I was you, my advice would be, you're going to be writing all the same documents. So I would probably steer away from doing it 5 places. But it might not be a bad idea to do it 2 places, right? And maybe you talk to 3 or 4 people, or look online, or get referrals from friends and family, and you say, here's the 3 or 4 places I might get a loan. The credit union that I used to belong to, my sister-in-law used somebody and said they were pretty good. I know that I should talk to a mortgage broker, so let me find a local mortgage broker who might be good. And then of the handful that you look at and you say, this person's got a good reputation, I see it online, this one seems like they're highly respected in this market, pick 2, get pre-approved with those 2, and then you're going to learn enough about that loan officer, their team, their process to say, you know what, I feel comfortable with this person. If you're borrowing hundreds of thousands of dollars and you're going through the biggest purchase of your life, you want to be doing it with somebody who you like and you trust. Sometimes, that's going to outweigh like, oh, I can get the very best deal. I saw some ad online and I'm going to save $462 in fees by using this online call center. Is that who you want to use, right? Like, you're driving your family around in your vehicle. Are you going to find like a tire shop with a good reputation? Uh-oh. Back on, I hope. It says my mic got unplugged. How'd that happen? Technical difficulties. All right. Don't know where I left off there, but you're not going to buy tires from the very cheapest, right? You might pay $30 more, but it's a recognized brand and good online reputation. Use them, right? You're driving your family around. The cheaper company sold you sand tires and it blows out and you swerve off the freeway. Not what you want to do, right? But by going through the pre-approval process, you're going to get a pretty good idea of how they operate. Okay, I like them and trust them. Then you get a quote. You say, okay, that looks like it's in line with what I should be getting. So maybe get one more just to say, okay, side by side, here's, what they look like. This one's slightly better than that. This one's slightly better than that. And then it's a few $100s difference. You decide who you like and you trust, right? Something important to think about there is I have yet to meet a first-time buyer who really knows how to compare quotes apples to apples. I got a quote today, and he told my team, this refinance client, hey, I think I'm going to go with this other one because it looks a little bit better. And I look at it, same rate, same everything. We're just $1,500 cheaper in fees. And because they had fancied it up and they had said, here's where you're going to get the refund of your escrow account, here's the savings here, and they added so many figures that weren't necessary, I guess in an attempt to make it look better than it was maybe. This consumer thought like they're better. And I said, strip away all this other stuff, just look at rate, cost for rate, and apples to apples were better. Thanks, Joey. I had to scroll down to make sure. I don't know. Look at this mic, dude. It's all banged up. I've dropped on the ground like 15 times. I'm not the sharpest tool in the shed. All right, Zeta, thanks for joining. I appreciate you being on here, as always. If rates go up, will prices go down? The answer is yes. The caveat is how much will rates go up and how much will that force prices down? If rates go to 3.25, you don't see a big change in housing prices. Everything else being the same, right? There's 1,000 other factors that could play into this, but if rates go to 4%, that's going to hurt. That's going to hurt buyers, right? And that's going to hurt purchase power, affordability. These words that like get thrown around. There's some legitimacy to some of the concerns people have. And so if rates go to 4%, we might see home prices level off, come down 5%, because it's going to hurt demand. And like that's where a simple mind like mine always just says, where are we at in the supply versus demand teeter-totter? Are we tons and tons of demand and a little bit of supply, and prices continue to go up? Once that starts to level out, prices kind of tame. I just hope for all the folks I have pre-approved that we start to, balance out a little bit. We thought we were seeing it the last 3 or 4 months. And like I said a little bit ago, over the last 30 days, I've seen supply wane a little bit, maybe at the same pace or more than like demand is waning, decreasing. And so it's wild. All right, Joey, saying all the nice words, man. I appreciate you, dude. I'm telling you, dude, we are all aligned. And that's the secret to success, man, is getting a group of people that are aligned with serving people at a high level, because it's fun. It creates a good work environment where we all feel good about doing right by folks. And then we, get more business, make more money, and all feel like we're making a difference. So I appreciate the kind words, man. I'm going to have a sign in the background coming soon. Matt, the mortgage guy, powered by you mortgage. We've got some stuff coming for the office, but maybe one of these weeks we'll do like an office tour. I'll take my camera and I'll twirl it around the office. Not yet, man. This place is a freaking disaster right now, but I'm moved into the Sacramento office and I'm excited about it. And the ability to lend nationwide. If anybody missed that, that's now a thing. I've got team members who are dedicated to different states. We're doing over 300 transactions in California alone per year. So I've got a large team that can handle that. Adding team members to handle out-of-state stuff. I think we got something going in Colorado. We got a deal going in Florida. We're rocking and rolling. Oh, I just saw a ping. I just saw Kraler Made with a $5 super chat, and I'm going to scroll down. My hope is that my buddy closed on my property and doing renovations before moving in. Yes, sir. I'll be working in all 50 states soon, so I wasn't able to help you with the purchase, but any future refinances, if you renovate and the thing is worth 100,000 more a year from now, you want to look at a refinance, see if it makes sense, I'd be happy to. And I appreciate your support, man. I appreciate the super chat. It's really cool to be able to live vicariously through all these people closing on loans. For Kraler made his first house ever. Excited for you, brother. Appreciate the support, and stoked, man. Stoked you got it closed, because I know it's not always an easy ride for self-employed borrowers, man. It's tougher to get a mortgage if you're self-employed, and anybody who's done a loan who's self-employed knows that. Somebody like me who's worked with 1,000 self-employed borrowers definitely knows that. So good to hear that that you're all closed up and now you're renovating. Jason Hibbert, thanks for joining, man. What makes one broker different than another? How or why do they provide different quotes and options? Well, different brokers in different geographical area, I guess even in the same area, are going to be set up different. Just like, one sandwich shop is set up different than the next sandwich shop down the road. They've got different margins set, and they've got, different ways they do business. And so the quotes are going to look different. We made a decision, me and my team, that we're zeroing out box A as of like October 1st. We're trying to be competitive. We're trying to do as much business as possible for as many people as possible. So we run off thin margins. We zero out box A, meaning there's no lender fee, there's no underwriting fee, there's no processing fee, there's zero fees. And in order to do that, we have to do more loans. We have to do more loans at a thin margin versus what you might see, Jason, if you know a loan officer who does 3 loans per month. They've got to charge more per loan to make the numbers work. If you do 300 loans a year, you're going to be able to make less per loan and still run a profitable business. So there's that. And then the other part of it is a lot of people call themselves mortgage brokers who aren't mortgage brokers. And I don't know a nice way to say it, but like somebody who works in the retail lending environment who says, no, I'm a broker. I've got the ability to broker. If it doesn't fit our company, like I can broker that out. They're not a broker. Mainly because they're running off their company's margins. Fat margins. Not throwing shade, telling the truth. Okay, enough about that. All right. Thanks for joining. Appreciate you, Tanisi Adams. In regards to currently working with a mortgage broker, do you think one would shop around to other mortgage brokers? You could, and I think that kind of piggybacks on Jason's question. If you call me and you say, hey, I'm pre-approved with this shop down the street, I know they're a mortgage broker shop, I know they do business similar to the way I do business, I'm going to say you're in good hands. And I'm not going to necessarily like do battle with another mortgage broker to win the business. If you call me and say, hey, I just got approved with Summit Funding, and I know that Summit Funding runs off massive margins and I'm able to get you 0.25% better with less fees, then I'm going to show you that. But that's the gist of it, I think. Probably, ties into the question above too from Sarah as a first-time home buyer. Get a couple quotes, but don't get 6. That's my advice. When I see somebody who gets 6 quotes, they've got so much information. It's hard enough to compare apples to apples on 2. And it really takes talking to someone who's honest and can say, listen, here's what I see, here's what we offer. Getting 6, your head's gonna spin and you're gonna pick not the best option. Vquez, good evening. Thanks for joining. All right, Jeanette, being a mortgage broker, are you searching for the best rate? Of course. But keep in mind, and this is important, I've been trying to teach, preach, and do all I can. The best rate isn't always the best deal. Because I can tell you right now, Jeanette, if you call me and say, I want the very best rate. Quick story. Somebody reached out to me and said, can you look at this? This is what I'm doing right now. They were set up on a 10-year term with 1.75% interest rate based on their loan to value, based on their credit score. This lender was charging them 4 points. Small loan amount. I was like, you know what? That doesn't make any sense. I look at my rate sheet as a broker. I can offer that same 1.75 for less than 2 points. So I can save them money, right? But then I look and I tell them, hey, after really looking at this, 1.875 or even 2% is a better deal. And I'll tell you why. If 2% costs 0 points and 1.75 cost, we'll just call it 2 points for now. It was $11 difference between 2%, 1.875. Another $11 between 1.875 and 1.75. So 1.75 and 2% on this loan amount was a $22 difference in payment. 10-year term, so 120 months. I'm trying to refresh my memory. I think it was like a $3,000 difference in cost. Now, if you take $22 times 120 months, the whole term of the whole loan, it's $2,600. So they were going to spend $3,000 of today's dollars to save $22 a month. The break even wasn't even until past the loan term. This was the best rate, like you said, the best rate, 1.75, was nowhere near the best deal. The best deal was 2% because they were saving $3,000 in today's dollars. Yes, they were paying a higher rate, $22 more per month, but they weren't paying $3,000 up front for the rate. So that's me preaching about the best rate isn't always the best deal. Most of the time, it's not. Quantrell. With new construction, do you have to go with a preferred lender in order to get the lot? Or could your lender of choice secure the lot? You do not have to use the builder's lender. When you go to a builder and you're trying to reserve a lot, more often than not, they make you get pre-approved with their lender. Doesn't mean you have to use them, right? And so depending on the builder, I literally had this conversation with my team today, and somebody on the team was asking, how often do they go with the builder's lender? How often do they go with us? I told the team member, it's probably 50-50. And here's what happens, Quantrell. Find a broker you like and trust, somebody on my team. Show them what the builder's lender is offering. And you look at it and you go, okay, I'm putting 10% down. I'm buying at this purchase price. They're offering me a 3.125. The mortgage insurance with them is $89 a month. And they're going to give me a $2,000 credit if I use their lender. Call us and we look at it and we go, the terms aren't that bad, but if you come work with us, we can get you 2.99. I can match that $2,000 credit, and our mortgage insurance is only $56 a month, not $89. So apples to apples, on the eighth in rate, you're saving $36. On the cheaper mortgage insurance, you're saving $33. We're going to save you $70 a month. Same cost structure. We're better. I've seen it where Lennar is a popular builder in California. They've got, it used to be Eagle Home Loans, and they just brought it all in-house. It's Lennar Home Loans now. On some of their developments, they will offer crazy incentives to use their lender. I understand why they want to keep it all in-house. It makes it easier and cleaner for them, and I don't really blame them. So they might be better. If you talk to a mortgage broker who's trustworthy, all on my team will tell you, use them, they're better. Keep our number. Call us down the road for refinance. Your cousin's looking to buy and they're buying a resale home where there's no, builder credit, builder incentive, lender credit.
we're more than likely the best option. Give us a call. Like I told my team today, we might not get that loan, but if we get 7 referrals over the next decade, we won, right? Because we gave honest feedback, gave honest advice. Uruguay, Uruguay. Congrats. Look at this. So this is a good sign. I'm seeing a bunch of people that got their offers accepted. Let me know what market you're in and what you had to do. I mean, at Sacramento, where I'm at, I'm seeing some crazy stuff. I'm seeing above ask, appraisal gap, all kinds of stuff that I would think would get it done. And some buyers are just having such a tough time. So I'm interested to know what market, how the offer was written. But whatever the case, congrats. I'm super stoked. Good to hear that people are doing that. Face too much. Thanks, man. It's exciting. It's fun for me. The goal is always serve as many people as possible. And a lot of times it's not like so I can brag about how much numbers we could do, or certainly not about money anymore. It's about more impact, more influence, building a team and watching the team members grow and whatnot. And so, yeah, it's exciting. It's exciting to be part of that. It's exciting to be part of a mortgage company who's got amazing culture and who's growing something special. So be on the lookout for some announcements from me in regards to U Mortgage, that transition, the new company and whatnot. Still transition in effect. Grand opening is not until next month. Some of the official announcement stuff is probably 2 weeks out, but you guys, the YouTube live fam, you guys always get a sneak peek into what's going on with me and my business and whatnot. So yeah, thank you. William Ramsey, thanks for joining. I have a mortgage on my primary, but I'm looking for a rental property using a conventional loan. Is debt to income ratio going to be an issue? What is ideal for lenders? Well, debt to income ratio is only going to be an issue if it's too high. And so while you're going to need more income as you start to add properties, it's not impossible. And a quick conversation could solve this. I think that my best advice is go see how much you qualify for. I literally had a client text me today, hey Matt, looking to buy an investment property. The refinance you did for me is $3,200 a month. I make $120 a year, no debt. How much can I qualify for? And it's fairly easy math to get a rough idea for what you'd qualify for. And in that case, I think it was 120 years, $10K a month, $3,200 mortgage on the first. If this specific client of ours goes out and puts 25% down on a new mortgage, and that new mortgage is, let's call it $2,000 a month, and it's going to rent for $2,500 a month, we can use their 10K in income, 75% of the $2,500 in rental income. Why do I use tough math? 6 1/4, 1875. So 1875 gets added to the 10K. Let's call it 11,875. 11,875 on the income side. Then you got 3,200 first mortgage, 2,000 on the second, 5,200. It's like a 44% DTI. Probably works. Probably needs to be in that 2K or below range on a mortgage, and being able to use the rental income, because you can use 75% of it. So that's how it's going to work, William. So I'd talk to somebody, and once you've had the initial conversations, if you're serious about buying, go ahead and get pre-approved. It certainly does not hurt. All right, I still didn't learn how to pronounce it, but Tanisi, Yes, Colorado. I got you. Got one started today from somebody in Colorado. So get with me. I'll connect with my buddy Brandon. He'll be able to answer any questions, get you started, get you rolling. Me and my team at U Mortgage are ready to serve you on any needs you have in Colorado. So greatmortgagebroker.com. Just fill that 6 questions out. They'll be coming. Yes, sir. Property number 2. Yeah. And as like your business grows, being self-employed isn't terrible. It's tougher when you're first starting. But once you've got a couple of years of tax returns where I know your business is growing and you're going to show enough income to be well qualified. Let's go get you, property number 2, 3, and 4. My lender seems to have a pretty fancy thought out website for making payments. Is that normal for lenders, even though they supposedly sell it within months? Yeah, because a lot of they're going to service for the first 6 months, 12 months on a ton of stuff, right? So before they sell it, like they want to have a good platform for servicing, collecting payments up front. And so, yeah, I think your question is like, why do they spend all this time like doing that when they're going to sell it long term? Because in the short term, they're going to have thousands of loans where they're servicing. You're welcome. You're welcome. Alex, how can brokers not charge any fees and keep the interest rates low? I think that was the second one. Mostly because mortgage brokers don't have the overhead of banks, direct lenders. I'm sending my loan directly to the wholesale lender. I don't have middle management and executives that are all getting a piece of the pie, right? And so if I have my margins set at, let's just call it 1.75%, and I'm sending it to a wholesale lender who's got their margin set at 0.8, then like there's 2.5% of margin total. In other types of setups, let's just call it like, I don't know, let's call it a direct lender. There might be 450 basis points of margin, some for owners, some for management, some for regional managers, some for branch managers, some for this, and then the loan officer gets 125 basis points, 1.25%. But there's 4.5% of margin built in versus 2.5% on the broker side. That $1,000 fee, that $1,500 in fees, I can cover that and still be 1.5% in front of, and I'm talking margin. I'm not talking rate. I'm talking about 150 basis points, maybe a quarter better than some other setups. So that might have been too complicated of an explanation, but yeah, that's how it works. Simple Service Mortgage, Orange County, California, aspiring MLO here. Cool, man. Keep watching. Let me know if there's anything I can help with. I know that like between live Q&As every single Monday for an hour and a half, you'd learn quite a bit. There's 1,000 different groups online where you can get inside of interaction with loan officers all day, every day. In California, 100,000 loan officers. And so I don't think you should take that as like, there's a lot of competition. I think you should take that as like, there's that many people who can do it and do it well enough to, keep it as a career and that you can learn from, right? Where you can jump into, Facebook groups or other, I'm sure like Reddit has forums where you can learn, but that's the name of the game. Learn, get better, add value, do loans, succeed, make money, retire, travel, enjoy. Good luck to you. Joey, a lot of YouTube collabs. Yeah, one rental at a time, every single Wednesday. We do 2 or 3 videos. So me and Mike probably have 50 videos now. Jeb Smith, enjoy doing stuff with him. Kyle Seagraves. I did some stuff with Jason Walter who's local to my Sacramento market. I did some stuff with Mark McDonough, who's local in my Sacramento market. Who else do I need to collab with? That's a good question. I don't necessarily have anybody who I'm like targeting and being like, hey, you guys should do a collab. But if you guys see somebody, start flooding their stuff with like, hey, you and Matt the Mortgage guy should get on and do something. Next week, I'm going to have Ryan Lundquist, Sacramento Appraisal blog. He's going to be on. So that'll be a lot of fun, man. If you didn't catch the last one we did, you'll enjoy him because he's just a wealth of knowledge. How does the bank look at rental income and losses? I have 2 rentals, but want to qualify for a third. It's all math, right? However it shows up on your schedule of real estate on your tax return, it's going to be plugged into an Excel spreadsheet that, shows us rental income. And if they're running at a true negative, like we're even adding back the tax and insurance and the other costs are still negative, then it's going to hurt your chances to qualify. But whenever you have a file that's in any way complicated, multiple rental properties, self-employed, combination of the both, multiple businesses, you always got to get pre-approved. You always got to talk to a lender and say, hey, please review this for me. I'm thinking about buying a third property. What I've seen a lot of people do, I might be guilty of doing this with some clients in the early days because I had more time and wanted to help, is a bunch of like calculations on a piece of paper, right? And like, okay, well, you got this, forget all that. Application, docs, get it all in, let a lender look at it, get a for sure answer. Messing around with your finances and like, oh, this should probably work is not how you want to roll. Admittedly, I did that with some clients, and it took longer, and it wasn't a concrete answer, but it's all right. All right. Since the pandemic changed the workplace setting to remote, would you say the mortgage industry achievable for someone who's disabled now in 2021? The mortgage industry is achievable for anybody who wants to put in the work to learn the business, who is not afraid of what will inevitably be like a learning curve and a ramp up of getting your business started, because you don't get your mortgage license and then voila, like 100 people your first year trust you enough to handle their mortgage. But if you put in the time, effort, energy to learn the business, and you have the right attitude of like, I'm going to serve people at a high level, I'm going to give them honest feedback. I think that's like the hardest part for so many people is it's commission based. And so you have to balance like serving people and giving people honest feedback without letting like your mind go to like, I need this commission. I need to make sure I close at least 2 deals this month, 3 deals this month. Even when I was very first getting started and I didn't have 47 deals in process, I always knew that I was going to sleep better at night. I was going to feel better about myself if I gave people honest answers. If I treated people as if like the advice I'm giving is what I would want to receive. And truth be told, I think what influenced me is a lot was in 2006, I got a mortgage. I was so surprised by the terms that I literally cried at the closing table because it was a friend of mine that got me the mortgage, and there was like 15,000 in fees that I didn't know about. Granted, 2006 is different than 2021, but I know from the very start, like I was going to be as transparent and honest and like do the best I could from the very start. I never thought about like, well, if I close an extra 2 deals, or I want to try to get to 5 deals this month or 6 deals this month. It was just service, value, educate, and the business will come. That's how I would approach the business. And if you do that long enough, hard enough, you're going to win. How about rate versus price? In New Jersey, where I'm looking at the average single house, used to be 280. Now they're going for 400. I mean, it's wild, but it doesn't surprise me. Like 280 to 400, that's like a 40% increase. That's pretty crazy. But I'm looking at stuff where like people bought for 375 and now it's appraising for 525 in my market or surrounding market. So I believe it. I think what your question is asking is if rates go up, prices come back down. The chances that that same house goes back to 280, I'm going to tell you right now, in my opinion, is 0.0042. Very friggin' low, like near impossible. I don't care what people say about like, I don't know. One, if you look at things, and I've seen people who are really smart show like the affordability index, where like truth be told, prices seem super high in a lot of places, but then the payment versus not just the payment versus what the payment was 5 years ago, but average wages and payment, they're not like exponentially less affordable. They're really not. And that coupled with wage pressure, inflation, the trillions that are being printed, like if you don't think it's causing inflation, you're out of your mind. That's a nice way to put it, right? Things are getting more expensive. Real assets like real estate is one of those things. I don't know. All right, on a 100K gross salary, how much loan can I max qualify? No other debt's an excellent credit. You can assume that you can go up to about a 40% debt to income ratio. So let's just call it great credit, 20% down. We'll call it 8,000 a month. 100K is about 8,000 a month. Just multiply that by 40%, 3,200. Depending on property taxes, homeowners insurance, the rate you're getting, your total payment's got to stay at 3,200 or below, right? And so I'm not familiar with Phoenix exactly, but I would guess that, let me see. Let me pull up an estimate real quick. I was going to just tell you, figure out what that payment is, but I'll give you some more concrete advice here. All right. Looking at a scenario, holy moly, from May of 2019, rate was 4.25. You guys forget how amazing rates are. All right, let's call it 20% down, like you said. No mortgage insurance. And I've got property tax at 1.25. I've got homeowners insurance guesstimates in here. If you bought for 700,000, you put 20% down, so you're borrowing 560. And property taxes, if they're similar to California, I don't know honestly what Phoenix is. I'm looking at like a 3,150 payment with a 2.8 interest rate on a 30-year fixed. So you're probably 650 to 700 purchase with 20% down. That's my guess, Harminder. But like I was saying earlier, you want to get yourself fully pre-approved to be absolutely sure. There might be some other factors that you're not thinking of, I'm not thinking of. And so get yourself fully pre-approved is my best advice. All right. Uruguay, St. Louis, Missouri. Negotiated the price down $4,000 and the seller gave me $3,000 in closing costs. Sweet. See? Getting offers accepted. Don't even have to pay full price. I like it. Jane, looking for the best HELOC. And here's my best advice. From what I've seen, because I can tell you with absolute certainty, I don't offer the best HELOCs. HELOCs are generally small community bank, small credit union. They're the ones that want like the banking relationship. Therefore, they offer you something like a HELOC where they know it's going to attract you to their bank, and they might get other services, credit card, business line of credit, checking, savings, all the stuff they want, right? Mortgage broker, I've looked at it. I've looked at it side by side with HELOCs that these banks can offer, and I'm like, no, we're not competitive. The lenders I work with don't want a $60,000 HELOC. It's just the truth, right? So I would do that. Here locally in California, I've got a good buddy who runs a California bank and trust. They offer some great HELOCs. If you're in California, shoot me a message, matt@mattthemortgageguy.com. If you're outside of California, I would do that. I would look small credit union, small bank. Oh, that's a good one. This is a good question here, Corey. Will inconvenient wet signature requirements eventually go away in the future? I know lenders are working on it. Like anything you can think about with technology, with innovation, is being discussed in executive meeting rooms at lenders, right? The underwriting process, they're looking at using technology to change that. The appraisal process, they're looking at changing that. The signatures, what I've heard, and this one I probably heard a year or two ago, was some sort of signing process that you do that's recorded, and it comes up and you say, I agree. And some of them you'll DocuSign on the form, and some you'll look at a page and you'll say, I agree, I consent. And they'll keep this recorded file where it's you on camera going through your loan documents. When you get to the end of the page, say, I agree. When you've seen this, say, I consent, whatever it is, right? I know that was in the works. There was trial periods with whatever lenders were piloting those type of programs. And I mean, I guess we're just trying to like not have fraud, right? And so mortgage documents are signed with a notary. So you can say, my right thumbprint, this is me, the notary confirmed it, I'm signing. If you have a recorded signing where you DocuSign on the screen, but it's also your face saying, I read this page, I consent. You know, have you read this page about discrimination? You weren't discriminated against? Yes, I read it. Have you seen this page about, loan options? And you know that there was different options? Yeah. Here's your, whatever the heck is in that 130 pages of loan documents. We'll see. It's an interesting question. And I'm sure like everything else, right? Technology is going to continue to advance. Things are going to continue to get easier, faster, cheaper, better. All right. Let me see. Pronunciation and English and all that other stuff's not my forte. I'm a numbers guy. Remember that, okay? Tennessee. What did I say? Tennessee? Did I say it like without enough pronunciation? Tennessee. Ryan, thanks for joining, man. Any way I can help, let me know. Ping me if you got questions, but congrats, man. It's the best job in the world. And here's another guy looking to become a loan officer. You already got Simple Service Mortgage. Looks like you got a YouTube channel. Start recording videos so that you're like learning on the job. You get a question from a family member, you get a question from somebody who's asking you. You don't know it, you have to go research it, you find the answer, record a video of you talking about it. Helps cement the information. Literally why I started doing YouTube videos. I wanted to like cement the knowledge I was learning in my head. And I told myself, if I make video on it, I'll spend a little bit of time researching it so I don't sound like an idiot when I record it. And I'll also kind of ingrain it in myself a little bit. So that's my advice. I said we personally, Harminder, don't charge those fees. Different brokers have different setups. Different lenders have different setups. In box A of a loan estimate, all lenders have to disclose a loan estimate. There will be points for the rate. There will be underwriting fee. There will be processing fee. There will be lenders can have different fees in that box. Different lenders charge different fees. We've usually done one flat fee of $10.55, which is what the lender charges. And that's all. Made a decision, me and my team, that we're going bigger, we're going stronger, and we're getting more business. So we're going to not charge that $10.55 fee. We're going to eat it on our side. So with that, we can now tell people box A is empty, no fees. Unless someone decides they want to pay for lowering the interest rate, which you can always do. And I've explained that in past videos and past lives where, you'll have the whole rate sheet to choose from. I mean, you might have 1.99 to 3.5 on a 30-year fix. You can choose the best rate and pay a lot for it. You can choose a higher rate and get rebate, get lender credit for it. All right, go do that, man. Looking forward to seeing you grow. Al Bundy. Yes, but you, one, have to be W-2 for multiple years. And two, they're going to look at it a little bit closer because it's you W-2 and yourself. And you can't have a business that's losing money, but W-2 and yourself 180 grand a month or a year. Either one of those, right? 180 grand a month, but it's losing. Not going to cut it. All right, we've got 20 minutes left. I bet we can get to lots of questions. Graciel Menor, home inspector for a new construction home. It depends on where you're at. I know a lot of home inspectors in Northern California. I know 0 home inspectors in other parts of the country. Maybe I know one in Idaho. Somebody who used to do home inspections for me in Sacramento moved to Idaho. If you happen to be in Northern California in Sacramento, shoot me an email, matt@mattthemortgageguy.com. I will refer you to a great home inspector. If you're outside of NorCal, then I probably don't know anybody. What? Al, you never run out of questions, dude. You got an endless supply of questions. This is, can a house ever record for change of ownership, but for some reason that gets undone and the house goes back to the seller's name after escrow? I've never seen it happen. I've closed thousands of deals. I've been around other people that have closed thousands of deals and never heard of that. So you're going to have the title company involved. You're going to have like a fully executed purchase contract. You're going to have a lot of things in place where that would be near impossible. V Quez, appreciate you. Thanks for the super sticker, man. It's very, very kind to you. And I appreciate it. Oh, this is a good one, Graciel. I've never thought about this, but if or when the house appreciates and the PMI drops off, would there be a predicament that lender puts PMI back into the loan if the house value drops? No. I think once they remove it, they're not allowed to put it back. And this is a great question because house prices don't always increase. We saw 12, 13, 15 years ago where home prices declined. It would be pretty wild to see somebody have their home price appreciate, PMI falls off, and they're like, oh, no. prices came back down. PMI's coming back. I don't think they can do that. I'm almost positive. That's a cool question though. How is commission pay included in your salary for qualifying for a refi mortgage? So if you're working for a company and that commission pay is part of your W-2, you might have salary, base pay, whatever you want to call it. Then you've got commissions. And here's something for anybody who gets paid on commissions, or a part of their pay is commissions, or it's bonus, or it's overtime. There's a bunch of different line items on a pay stub that are all treated the same. In your case, you're asking about commissions. So you've got a base pay of $4,000 a month, plus you get paid commissions based on how many widgets you sell. I was trying to think of something creative. Nothing came. So I just said widgets. It's going to be a 2-year average. And where people run into trouble is if you don't have a 2-year average, you basically can't use that. We can only use that $4,000 a month base pay. So in your case, Michelle, 2019, you made $48,000 in base and you made $42,000 in commissions. Then in 2020, you made that same $48,000 in base and you made $56,000 in commissions. We're going to take those 2 years, we're going to average, and then we're also going to look at the year to date from 2021, and we're 9 months of commissions deep into 2021 that we can look at. Most lenders are going to take those 9 months plus the past 24 and do an average of the 33. So we'll look back at 33 months worth of commissions and take an average of it. Same thing goes for bonus, overtime, anything like that. And so some people, if you didn't have it in 20, but you had it in 19, now you have it again in 21, it's going to be tough. Yeah, there's lenders, Maria, that will work with, down to a 500 credit score really with FHA, but FHA 580 to 620 is a bucket where I know as a broker, I'm going to take it to certain lenders who are more flexible with credit score and more flexible. There's generally one part of it is a score, right? And you've got a 586 mid score. Well, to have a 586 mid score, there's going to be some derogatory stuff on your credit report. It's going to be a bunch of debt. It's going to be some, 30, 60 day lates. It's going to be, a BK that discharged 4.5 years ago, whatever it is. Like that's another piece, right? Where the lender is going to look at that and determine, approve or not approve. You're going to inevitably need to be strong in other areas if the credit is less than perfect. So, 585 credit score is not going to kill you if you've got good income, you've got a down payment and whatnot. It's just going to, in my case as a broker, mean I'm going to take it to the lenders. EPM is a lender, Equity Prime, based out in Georgia. I like a lot, and I can do loans with them all day, every day, and get fairly good terms on that specific bucket, like 580 to 620 credit score, FHA. So send them on over. Happy to help. How soon can someone refinance after a loan mod? It's a good question. And honestly, I'm going to tell you that I have not dealt with this at all. I've had conversations with clients about their loan modifications and whatnot. If you're going to refinance, don't do a loan mod. That's my advice, because there's no reason to. Like a loan modification is only like, okay, these terms seem great. I'm going to stick with this. I'll take this. If you're going to refinance, whether it's a rate and term refinance or cash out refinance, just come out of forbearance and we'll do the refinance. But every loan mod's different. I feel like some of them, like it's showing up derogatory on credit scores, and so it might be an issue. I agree. I think more and more people are doing it. You want to hear a crazy stat? In 2022, 82% of consumed content online is video. So people who are trying to reach any sort of client, whether it's mortgage or real estate or whatever, and they're not using video to do it, doing it wrong. Great question for an aspiring loan officer. Do you think having a real estate license can give more credibility when advising a client? Is it a good idea to obtain both? I got my real estate license back in 2018 when I went over to the mortgage broker side. I never used it to close a deal. One, you're going to be working alongside a bunch of real estate agents. So if you're competing with them for real estate deals, I don't think that's a good look. You know, my wife and I have been involved in a lot of real estate transactions in the last 5 years. Never once used my license, let somebody else represent me, let a realtor partner that we do business with represent us on the purchase of properties. And so I don't think it's really necessary. And I think that if you talk to anybody who's high level mortgage professional, you can be mediocre at both, or you can be really good at one. So I guess it's up to you to decide. Do you want to be an all right loan officer and a halfway decent real estate agent? If you're not planning on doing real estate, then no value in getting a real estate license. If you are planning on doing real estate, I still think it's not the best idea, because it's just going to not allow you to go all in on a mortgage and be the best you can be in the mortgage space. My personal opinion, some people do both and they do it okay. There's nobody that's doing 300 million a year in mortgages and also doing real estate. I can tell you that, and vice versa. There's nobody who's doing $250 million a year in real estate and also doing mortgage. You know who I should check in with is David Green. He started a mortgage company. He's a real estate agent, co-host of Bigger Pockets podcast. He might be the exception to the rule. I think he might be doing both at a high level, and he's built teams in both areas, on the real estate side and the mortgage side. And if anybody could do it, I think it could be him. But for your average person who's trying to get started in one or the other, I think it's a good idea to go in one lane and press down on the gas and just look straight forward in that lane. That's my 2 cents. Okay. I think I get it now. It's not just about rates, but entire formula. How long does it take to get your money back? How much you save a monthly through the entire loan? That's exactly right, Jason. Is, the 2.625 with $8,000 in cost versus the 2.875 with zero in cost. You have to take into account that $8,000. If that $8,000 only buys you $44 a month in savings, then you're out of your mind to spend that $8,000. The problem is people are blinded where they're like, 2.625 sounds like a great rate. And companies understand that people are blinded by rate, and they're like, 2.625. What I just watched some movie where the mouse was like following the cheese like that. And you guys all follow the cheese. Your nose is up, and you're, I think, was it a Tom and Jerry movie? I got kids, so yeah, it's like a movie in the park, and the mouse was following the cheese. Don't be like that with interest rates. You're going to end up finding a big $8,000 cheese sandwich. And so best rate is not always the best deal. You nailed it, Jason. All right, Dixon, California. You know what? Just shoot me an email, because I'm thinking of a guy. He might go out to Dixon. Sean, is that his name? Great dude. He wouldn't mind this. This guy does some high level. Sean Leehart. Actually, you know what? Send me a direct message. I don't know, just in case he doesn't want me sharing his information on here. Graciel, I'm not going to share his phone number. Home inspector. But that's the guy. I'm going to get you his phone number. Give him a call. He's great. Partial appraisal waivers? The heck's a partial appraisal waiver? That's, I don't know what that is, but tell me. My guess is that somebody's using this crazy term as marketing. It's not a real thing. Because if it's something to do with lending and me and my team haven't heard of it, it's probably not real. But people use the craziest things. Like there was like an appraisal gap insurance that some lender was offering. And it was just like, if the appraisal comes in light, we're going to restructure your loan. Everyone can offer that. But a lender was like, you know what? People have problems with appraisals. I know a way to market. Sorry, I think that was loud in the mic. I heard that. Probably fake news. Let me know. Shopping around to refi my FHA loan. Yuri, you came to the right place for this advice. I forwarded this video to somebody earlier. Compare loans. There we go. This is a short 3-minute video. Don't go to it now because you want to stick around, but I'm going to put the link in the comments, or you could just write down a note to yourself to look for how to compare mortgage offers. And here's what you want to do, Yuri. Different lenders show loan estimates differently. With everything that goes into it, prepaying your property taxes, prepaying your homeowner's insurance, interest for this many days, credit report, appraisal, whether you need it or not, all this stuff, right? Ignore all of it. Look for lender fees, points for rate, and the rate. Only that. If it's structured like a loan estimate, how we do it, that stuff's all in box A. Example. You're looking at 2 different loan estimates and they look completely different. One lender's, showing you 3.125, another lender showing you 2.999. You say, oh, 299 looks great. Somewhere in there it says 0.8 points. And so $400,000 loan, that's a $3,200 cost. And they've got $995 underwriting, and they've got $795 processing. The 3.125, 0 points. And they've got one flat fee of $1,055 instead of that $795 and $995. $1,800 effectively. 0 points, $800 less on the other fees. And so between those 3,200 points and the $800 less, it's $4,000 better. Sure, it's 1/8% higher, but if it's $4,000 better and that 1/8% is only a $26 difference in payment, that's your better deal. It's going to take you weeding out a bunch of junk to really see which one's better. Ideally, same interest rate, then you can just compare the fees. Here's what you don't want to do. Don't look at like how much you're paying in prepaid taxes and insurance and all that stuff, because it's going to be the same no matter where you do business. The only time it's different is when one lender goes, oh, you know what? I'm going to see if Yuri catches this. Instead of holding 9 months of property taxes and 8 months of homeowners insurance, I'm going to show that I'm only going to withhold 4. Once we get this thing rolling, we'll hit them with the full 9 because we have to. We got a tax payment coming up in 5 weeks, and we got to, have a little buffer in the escrow account. So I know we got to hold 9. It's not always going to look so simple, I guess, is my advice to you. Rate, cost for rate, and lender fees. That's all you got to look at. The other stuff is fluff. How much is a typical refinance cost? Does it vary depending on your LTV? Well, it could vary depending on your LTV, your credit score, whether you're doing a cash out, whether you're doing a rate and term. But if you're looking at a true loan estimate, left-hand side has loan costs. Right-hand side is generally all the prepaid tax and insurance. On the left-hand side, it should be somewhere between $2,000 and $3,000. And that can be title fees, appraisal, lender fees, all that stuff rolled in. Maybe sometimes it's a $700 appraisal and that total is $3,200. That's about what you should be on that side. Take into account if you're doing a cash out of an investment property up to 75% LTV and you've got a 685 credit score, you might have to pay a point. You might have to pay a half a point for that rate. And then that jacks those fees up a little bit, right? The right-hand side, all the prepaid stuff, like I said, ignore that because it's the same no matter where you're going to. And if you're setting up the escrow accounts, those are future payments made on your behalf. You're getting a refund of your old escrow account back. You're missing a mortgage payment. You're getting that money back. So that's all going to come out in a wash. You just want to look at left-hand side, true fees. And those should be 2,500-ish. Gracias. That's why I love you, Al. They're very random and rarely related to each other, but that's why it's good to have you here. Michelle Buckhoff, super sticker. Man, you guys are on fire with the super stickers and super chat. I appreciate the heck out of everybody who's joining. This is fun. This is cool stuff. It's different every single week. Most people you talk to, and I talk to tons of people in tons of different professions. If you're seeing new stuff every day, the job never gets boring. And that's the beauty of this, right? Is like different questions every single Monday, different people with different scenarios. I'm really enjoying it. So thank you guys so much. I appreciate the super stickers too. I can go home and brag to my boys, let them know that I'm getting super stickers on YouTube. In this market, what's most likely to happen if a house appraises lower than the purchase price? It's a good question, Bronson. And a conversation I had last night with a neighbor of mine, he told me his son's buying in Las Vegas. And I just thought to myself, like, man, I have a lot of conversations around mortgage and real estate, whether it's talking to my neighbors, or talking to my family, or in this office for 12 hours a day talking to people. It should always, always, always be discussed beforehand. It should be written into the contract beforehand. It shouldn't be something that comes up at the end. Like this neighbor was telling me his son's buying in Las Vegas and he's in contract at 240, it appraised at 220, and now they're like, what do we do? Well, this should have been in the contract. This should have been very clear. If it comes in less, buyer's willing to pay $5,000 above appraised value, willing to pay $10,000 above appraised value. I'll tell you, Bronson, that like every single offer that is written with agents who I work with, that is written into the contract. In a seller's market like we're in right now, it's almost always required that you either waive the appraisal, put something in that you're willing to pay $5,000, $10,000, $20,000 above the appraised value, something to let the seller know this thing is going to get to the finish line, even if the appraisal comes in a little bit light. Because there's so much demand that if it comes in light, there's someone willing to pay above what it appraised at. And so it's more often than not written into the contract. In the rare cases it's not. I don't think I would expect sellers to budge that much off of that agreed upon price. If you agreed to pay $330 and it came in at $315, one, it should have been negotiated beforehand and the seller's agent missed by not having something written in. But if it wasn't, maybe they meet in the middle. More often than not, like the buyer's going to have to come up. So that's my 2 cents. Frustrated cowgirl. Sorry to hear you're frustrated. Have to buy my auto lease. Going to buy within the year. Best way to maneuver like type of auto loan, etc. Length of time. So you're curious on what type of auto loan you should get because you're going to buy a house within the next year? If that's the case, then don't get into a big car payment. That's never a good idea. So, I mean, in that case too, like you want your smallest payment possible so you can qualify. So like the 72 month, they do 84-month auto loans now too. I'm erasing to make room for this next question because I like to put notes. It's a good question coming up from Lamont. I have 10 or less payments on a personal loan. It is still a part of my DTI for pre-approval. I'm almost positive it's not. And I say almost positive because like revolving or installment debt, if you have less than 10 payments, like on a car loan, we can omit the payment. Don't have to use it. If it's a personal loan, that's an installment loan by most accounts. So we prove that it's got less than 10 payments. We can omit it. I'm 90% sure, Lamont. All right. IND Keith, let us know, man. Happy to help on your next investment purchase in Missouri. So congrats on the one you're closing tomorrow. If you own your own business, we're getting those business tax returns out, so it's gonna show up. It's gonna show up that you've got W-2 wages paid to yourself. Simple Service. This is the first time you caught me, man. This is every Monday. Every Monday at 6 p.m. Pacific Standard Time. More often than not, it's just me, just live Q&A. I had a bunch of people requesting my buddy Ryan Lundquist, so next week it's going to be both of us. We'll talk about real estate. We'll talk about appraisals. We'll talk about any mortgage question you have. But I have fun every Monday. We get 40 or 50 people that join and ask questions just like tonight. And so I hope to see you back next week. I will be here. I'm going to wrap it up. Let's see if I can answer some questions. I think I'm running out of gas here. All right, Graciel. Yeah, message me. We'll get you that home inspection info for sure. Oh, see, Yuri? Hours on the phone with 4 different lenders. If I can be of assistance, let me know, man. Shoot me and my team an email, matt@mattthemortgageguy.com. Thank you. Thanks for joining. If it wasn't for you guys and all the good questions, there would be no live. So you guys are the real MVPs. Weird question. Is it possible to have it all? Have you ever seen someone get a lower rate, lower monthly, remove PMI, and cash out? Yeah, I mean, I've seen some amazing refinances, Jason, where somebody pulls out $200,000 in equity, they lower their interest rate significantly, they remove PMI, and they're paying $175 less per month with $200,000 cash in the bank. Like, it's possible to have it all. I've had a bunch of different scenarios, a bunch of different things. So far this year, the coolest one was refinance where somebody owes somewhere in the neighborhood of 1.3 million. And so, as you can imagine, going down 1.5% on a rate there is like a $1,750 a month savings. Huge savings. $750 a month is someone's home mortgage payment. Most people watching on the live, and this client's saving that per month. So not too bad. This is a good question. Who picks title and escrow for a refi? If it's the lender, should we look for these price differences? Not really. Like, it's all so similar that if you're choosing a lender because one's got $75 cheaper title, you're doing it wrong. Tanisi, you're very welcome. Appreciate you joining. Yeah, I mean that's pretty common, Bronson, in lots of different markets, right? You're just having to write in that appraisal shortfall. Your realtor should be able to give you an idea too of like, yeah, it should appraise for this amount, shouldn't be, that. But I mean, if it appraises, let's say that you said you'd pay up to 10,000 above appraised value, up to the max purchase price of 280. If it appraises at 255, and you're only going to do a shortfall of 10K, and so that you're paying 265, if the seller goes for it, if you tell them, listen, we're paying 10K above what it appraised at, we're paying 265, like don't risk another short appraisal. If they go for it and you pay 265 for what you're willing to pay 280 for had it appraised, maybe it come out better. So who knows? Jeanette, let me see if I got it here somewhere. There it is. Bam. Matt at mattthemortgageguy.com. Oh, the camera's on point? Yes. Yeah, I had my team at U Mortgage sent me new camera, new ring light. Look at this thing. Holy moly, that thing's, you can't tell. It's big. I'll let you guys see more of the office next week. For now, it's a disaster. You can't see it, but once we get the office organized, we'll give you guys a sneak peek. Oh yeah, tap the like button. See if we can get some likes in here before we shut this thing down. Where are we at likewise? Who's keeping track? 30 likes or so. I don't know. I'm all right, guys. I'll survive. Thanks to everyone for joining. I really appreciate it. Check out tomorrow's video, right, where I talk about that viral TikTok video every Tuesday, Thursday, and Saturday. For now, I might change based on when people are watching, but for now, Tuesday, Thursday, Saturday, new videos every single week on all kinds of different topics. Monday, 6 p.m. Pacific Standard Time, live every single week until I run out of voice and I'm tired. My family misses me and I got to go home. Appreciate y'all. See you next week.